Hello, everybody. Welcome to Clef Investments. Let's continue to talk about the most important investment strategy that this channel recommends to everybody, which is buy and hold US Broad Market Index. It's very easy to operate, but you need a very strong conviction in order to strictly follow it for many years. That's why I'm repeating many of the important points that I talked before. So in a former video, I talked about why we want to use the US stock market. It's because US stock market is the best, has the highest historical return, and may have the highest future return. In another former video, we talked about why we want to buy broad market index instead of picking stocks. This is because we want to avoid the zero-sum game against professionals. And in another video, we talked about why we buy and hold instead of time the market, buy low, sell high. That's also because we don't want to play a zero-sum game against professionals. And also, if we time the market or pick stocks, it can generate very high capital gain tax. In California, for short term, it's over 50%. And that means if you want to get 10% after tax return, which is easy if you buy and hold the index, you need a more than 20% before tax return, which is super hard. And in another video, we talked about how to buy. Basically, dollar cost average is a very easy method if you have regular income. Even if you have a lump sum of money, you can still use DCA to invest all your money in a few months. And today, let's talk about how to add and remove stocks to your stock portfolio. So basically, sometimes some good companies become bad. You don't want to hold them anymore. And sometimes new stocks become good. You want to add them into your portfolio. So if you buy and hold the stock index, all of this will be done for you. This is because index will pick the good stocks according to its criteria automatically. So for S&P 500, such as VOO, there is a committee that decides what stocks to add and remove. And they follow a specific criteria and they manually decide and or remove certain stocks. For Nasdaq 100, which is QQQM or QQQ, it's more rule-based. It's also decided by a committee. And they basically pick a company that's listed on Nasdaq Stock Exchange, whose market cap is ranked in the top 100. Or if that company becomes too small, it's ranked beyond 125, it will be removed from the Nasdaq 100 index. And also, this stock cannot be a financial company. And there are a few other smaller rules. So index will do this for you when something happens or regularly. They meet like quarterly or every year. They decide what stocks are good or bad and adjust the index for you. And the best thing about this is because you buy and hold an ETF, exchange traded fund, it automatically tracks the changes in the index. And it does so in a good way because this is tax free. So if you hold 500 stocks of the S&P 500 in your portfolio, if you simply buy and hold, later if a stock is dropped out of the index, you have to sell it, which may generate capital gain. But if you buy and hold the ETF, then it's all tax free. So please note that if you buy and hold a mutual fund, it may not have this effect, except for Vanguard funds, because Vanguard manages their funds in a way similar to ETF. So if you are buying and holding a stock index in your non-retirement account, which means it's a taxable account, you better use ETF, not mutual fund. Okay, that's all for today. Thank you.